Introducing a beginner's manual on technical analysis, a comprehensive video series tailored specifically for those who are new to the world of trading. Whether you're just starting out or looking to deepen your understanding, this series is your roadmap to success. Throughout the series, we'll cover everything you need to know to get started with technical analysis. From understanding chart patterns to deciphering key indicators, each episode will equip you with the knowledge and skills necessary to make informed trading decisions. So, if you're ready to take the first step towards becoming a confident and successful trader, be sure to subscribe to our channel and hit that notification bell so you never miss an episode. Together, let's unlock the secrets of technical analysis and pave the way for your trading journey. Let's dive in. Hey there, traders. Welcome back to Risk with Purpose, your ultimate destination for learning to trade with confidence and precision. I'm Technical Tiffany, and in today's video, we will introduce you to the fundamental concepts of chart patterns, focusing on three primary categories: consolidation, continuation, and reversal patterns. Let's get started. Introduction to chart patterns: consolidation, continuation, and reversal. Consolidation patterns. Consolidation typically occurs after a prolonged period of price movement in one direction, whether upward, uptrend, or downward, downtrend. As the market participants reassess their positions and market dynamics, the price movement slows down and trading activity diminishes. During consolidation, the price fluctuates within a defined range, bounded by support and resistance levels as buyers and sellers compete for control. One of the key characteristics of consolidation is a decrease in volatility. Volatility measures the magnitude of price fluctuations over a specific period. Volatility is typically measured using statistical metrics such as standard deviation, variance, or historical volatility. These measures quantify the extent of price fluctuations observed in the past or expected in the future. Volatility tends to increase during periods of uncertainty or significant market events, such as earnings announcements, economic reports, geopolitical tensions, or unexpected news releases. During consolidation, volatility tends to decline as the price range narrows and trading activity decreases. Analyzing volume is another factor in recognizing consolidation in trading. Although trading volume might start off high when consolidation patterns begin to form, it usually diminishes as the pattern progresses. A decrease in volume during consolidation suggests a lack of firm commitment from traders, reinforcing the phase of uncertainty and balance in the market. The duration of consolidation can vary widely, ranging from a few days to several weeks or even months, depending on market conditions and the time frame being analyzed. Shorter consolidation periods may occur within larger consolidation patterns, forming nested or fractal patterns on the price chart. Consolidation often precedes a significant price movement, as traders anticipate the direction of the breakout. Many traders employ various strategies during periods of consolidation. The range-bound market dynamic opens the door to range-bound trading strategies that involve buying near support levels and selling near resistance levels, profiting from the price oscillations within the consolidation range. Additionally, traders can implement breakout trading strategies where a trader enters the market when the price breaks out of the consolidation pattern, aiming to capture the momentum to come. Continuation patterns. Continuation patterns occur during a trend and suggest that the prevailing trend is likely to continue after the pattern completes. Let's look at some of the most common continuation patterns. Flag and pennant. Flag and pennant patterns are chart patterns that signal a continuation of an existing trend. They typically occur after a strong and rapid price movement, representing a brief pause or consolidation before the trend resumes, known as the flagpole. This initial move can be either upward, bullish flag/pennant, or downward, bearish flag/pennant, reflecting strong buying or selling pressure. Following the sharp price movement, the price enters a consolidation phase characterized by narrowing price ranges. During this phase, trading activity may decrease as the market digests the previous move. The consolidation typically takes the form of a rectangular pattern for a flag or a triangular pattern for a pennant. In addition to the narrowing price ranges, volume tends to decline during the consolidation phase. This decrease in volume reflects a temporary equilibrium between buyers and sellers as they assess the next potential direction of the market. The flag and pennant patterns are considered continuation patterns because they often lead to a breakout in the direction of the preceding trend. Once the consolidation phase is complete, traders anticipate a resumption of the initial trend. The breakout is confirmed when the price moves beyond the boundaries of the flag or pennant pattern, accompanied by an increase in volume. Traders often use the height of the flagpole, the distance from the start of the initial move to the highest or lowest point of the flag or pennant, to estimate a price target for the subsequent breakout. This target is projected in the direction of the breakout and provides an objective for potential price movement. While flag and pennant patterns can provide valuable signals, it's essential to wait for confirmation before entering trades. Confirmation typically involves waiting for the breakout to occur and ensuring that it is accompanied by sufficient volume, signaling genuine market participation. Symmetrical triangle. Symmetrical triangles are chart patterns that represent a period of consolidation in the market. They are characterized by converging trend lines, where the price oscillates between gradually decreasing highs and increasing lows, forming a triangular shape. Symmetrical triangles are formed by drawing two trend lines, one connecting the lower highs and the other connecting the higher lows. These trend lines converge towards each other, creating a symmetrical shape resembling a triangle. The convergence of the trend lines indicates that the trading range is narrowing over time. Symmetrical triangles reflect a period of indecision among traders, where buying and selling pressures are roughly balanced. As the price swings between higher lows and lower highs, neither buyers nor sellers have gained control over the market direction. This indecision is visually represented by the symmetrical shape of the pattern. Symmetrical triangles typically occur after a significant price move, representing a pause or consolidation phase in the market. During this period, traders reassess their positions and wait for clearer signals before committing to new trades. The narrowing price range and decreasing volatility are characteristic of this consolidation phase. While symmetrical triangles suggest indecision in the market, they are considered continuation patterns because they often precede a resumption of the prior trend. The converging trend lines imply that the market is coiling or building up energy, potentially leading to a breakout in the direction of the preceding trend once the pattern resolves. The resolution of a symmetrical triangle occurs when the price breaks out of the pattern, moving beyond one of the trend lines. Traders anticipate the breakout to confirm the resumption of the prior trend. A breakout above the upper trend line suggests a bullish continuation, while a breakout below the lower trend line indicates a bearish continuation. Volume confirmation. Similar to other chart patterns, traders often look for confirmation through volume when a breakout occurs from a symmetrical triangle. Ideally, a breakout should be accompanied by an increase in volume, indicating strong participation and conviction in the new direction. Traders may estimate a price target for the breakout move by measuring the height of the triangle from the widest part and projecting it in the direction of the breakout. This projected target provides a potential objective for the price movement following the breakout. Ascending triangle. Ascending triangles are chart patterns that typically signal a bullish continuation. They are characterized by a horizontal resistance line and an ascending support line. Ascending triangles form when the price of an asset consolidates within a tightening range, with the upper boundary forming a horizontal resistance level and the lower boundary forming an ascending support trend line. Visually, this creates a triangle shape with a flat top and rising bottom. The horizontal resistance line represents a price level at which selling pressure historically prevents the price from rising further. Each time the price approaches this level, sellers tend to enter the market, creating resistance. The ascending support line, on the other hand, reflects increasing buying interest as the price consistently makes higher lows. This ascending trend line indicates that buyers are becoming more aggressive and willing to step in at higher price levels. Ascending triangles are considered bullish continuation patterns because they typically occur within an uptrend. As the price consolidates within the triangle formation, buyers continue to show strength by pushing the price higher, albeit at a slower pace. This suggests that the underlying uptrend is still intact and may resume once the pattern resolves. The breakout from an ascending triangle occurs when the price breaks above the horizontal resistance line. This breakout signifies that buying pressure has overwhelmed selling pressure, leading to a potential continuation of the prior uptrend. Traders often interpret this breakout as a bullish signal and may enter long positions in anticipation of further price appreciation. Similar to other chart patterns, traders often look for confirmation through volume when a breakout occurs from an ascending triangle. Ideally, a breakout should be accompanied by an increase in trading volume, indicating strong participation and conviction in the upward move. Traders may also estimate a price target for the breakout move by measuring the height of the triangle from the widest part, the base, and projecting it upwards from the breakout point. This projected target provides a potential destination for the price movement following the breakout. Descending triangle. Descending triangles generally indicate a bearish continuation. These patterns are identified by the presence of a horizontal support line and a descending resistance line. Descending triangles form as the price of an asset consolidates within a contracting range. This consolidation entails a horizontal support level and a descending resistance trend line, creating a triangular shape with a flat bottom and declining top. The horizontal support line represents a level at which buying interest historically prevents further price decline. Buyers typically enter the market when the price approaches this level, creating a support zone. Conversely, the descending resistance line indicates increasing selling pressure, resulting in lower highs. This trend line suggests that sellers are gaining control and are willing to sell at progressively lower prices. Descending triangles normally occur within a prevailing downtrend. Despite consolidation, sellers continue to exert downward pressure, implying that the existing downtrend is likely to persist once the pattern resolves. Breakout from a descending triangle occurs when the price breaches the horizontal support line. This breakout signifies that selling pressure has overwhelmed buying pressure, potentially leading to a continuation of the downtrend. Traders often interpret this as a bearish signal and may initiate short positions accordingly. Traders often search for confirmation through volume when a breakout occurs from a descending triangle. An ideal breakout is accompanied by increased trading volume, indicating strong participation and conviction in the downward move. Traders may estimate a price target for the breakout move by measuring the height of the triangle from the widest part and projecting it downwards from the breakout point. This provides a potential objective point for the price movement following the breakout. Reversal patterns. Reversal patterns occur at the end of a trend and signal a potential change in market direction. Let's take a look at some of the most common reversal patterns. Head and shoulders. The head and shoulders pattern is a well-known technical analysis pattern that often indicates a potential trend reversal in the market. The pattern is formed by three peaks in the price action: a higher peak, the head, located between two lower peaks, the shoulders. Visually, it resembles the shape of a head and two shoulders, hence the name. The left shoulder forms the first peak in the pattern, typically during an uptrend. After reaching this peak, the price retraces, but does not fall significantly. The head forms the highest peak in the pattern, showing the highest price reached during the uptrend. This peak is higher than both the left and right shoulders. The right shoulder forms the third peak in the pattern, similar in height to the left shoulder. It occurs after the head and typically marks the end of the uptrend. The neckline is a trend line that connects the low points of the troughs between the left shoulder, head, and right shoulder. It serves as a support level for the price during the formation of the pattern. The head and shoulders pattern is considered a reversal pattern, indicating a potential shift from a bullish trend to a bearish trend. The reversal signal is triggered when the price breaches the neckline support after the completion of the pattern. As with all of the aforementioned patterns, volume analysis is often considered when interpreting the head and shoulders pattern. Ideally, volume should decrease as the pattern forms and increase when the neckline support is breached, confirming the reversal signal. Traders often estimate a price target for the potential downward move by measuring the distance from the head to the neckline and projecting it downward from the breakout point, providing an objective for the potential price movement following the pattern's completion. And let's not forget confirmation. Confirmation is key. Traders typically wait for the price to close below the neckline to confirm the validity of the pattern before considering taking a position. Additionally, observing other technical indicators and factors can help strengthen confidence in the reversal signal. Inverse head and shoulders. The inverse head and shoulders pattern often signals a potential trend reversal from bearish to bullish. The pattern is essentially the mirror image of the traditional head and shoulders pattern. Instead of three peaks like in the head and shoulders pattern, the inverse head and shoulders pattern consists of three troughs, a lower trough, the head, between two higher troughs, the shoulders. This pattern resembles the shape of a head and two shoulders, but upside down. The left shoulder forms the first trough in the pattern, typically during a downtrend. After reaching this trough, the price bounces, but does not rise significantly. The head forms the lowest trough in the pattern, showing the lowest price reached during the downtrend. This trough is lower than both the left and right shoulders. The right shoulder forms the third trough in the pattern, similar in depth to the left shoulder. It occurs after the head and typically marks the end of the downtrend. Similar to the head and shoulders pattern, the inverse head and shoulders pattern also has a neckline. However, in this case, the neckline is a trend line that connects the high points of the peaks formed between the left shoulder, head, and right shoulder. It serves as a resistance level for the price during the formation of the pattern. The inverse head and shoulders pattern is considered a reversal pattern, indicating a potential shift from a bearish trend to a bullish trend. The reversal signal is triggered when the price breaches the neckline resistance after the completion of the pattern. As with the head and shoulders pattern, volume analysis is taken into consideration when reading the inverse head and shoulders pattern. Preferably, volume should decrease as the pattern forms and increase when the neckline resistance is breached, confirming the reversal signal. Traders estimate a price target for the upward move by measuring the distance from the head to the neckline and projecting it upward from the breakout point. This anticipated target provides an objective for the price movement following the pattern completion. Confirmation is essential when trading the inverse head and shoulders pattern. Traders typically wait for the price to close above the neckline to confirm the validity of the pattern before considering taking a bullish position. Additionally, other technical indicators and factors can be used together to strengthen the confidence in the reversal signal. Double top and double bottom. A double top pattern occurs when the price reaches a significant high, pulls back, rallies again to a similar high, forming the second top, and then reverses direction. Visually, it resembles the letter M with two peaks of similar height. The formation of a double top pattern hints that buyers have attempted to push the price higher twice, but have failed to sustain the upward momentum. This failure indicates exhaustion of buying pressure and may signal a potential reversal from an uptrend to a downtrend. Traders typically wait for the price to break below the neckline, which is a support level formed by connecting the lows between the two peaks. The breakout below the neckline confirms the completion of the pattern and validates the reversal signal. A double bottom pattern occurs when the price reaches a significant low, bounces back, declines again to a similar low, forming the second bottom, and then reverses direction. Visually, it resembles the letter W with two troughs of similar depth. The formation of a double bottom pattern suggests that sellers have attempted to push the price lower twice, but have failed to sustain the downward momentum. This failure implies exhaustion of selling pressure and may signal a potential reversal from a downtrend to an uptrend. Traders typically wait for the price to break above the neckline, which is a resistance level formed by connecting the highs between the two troughs. The breakout above the neckline confirms the completion of the pattern and validates the reversal signal. Volume analysis is frequently considered when interpreting double top and double bottom patterns. Ideally, volume should decrease as the pattern forms and increase when the breakout happens, confirming the reversal signal. Traders can then estimate a price target for the potential move by measuring the distance between the peak or trough and the neckline and projecting it upward or downward from the breakout point. The projected target provides an objective for potential price movement following the pattern completion. Triple top. A triple top pattern occurs when the price reaches a significant high, retraces, rallies back to the same level, forming the second top, retraces again, and then rallies once more to approximately the same level, forming the third top, before reversing direction. Visually, it bears a resemblance to the letter W, with 3 peaks of almost equal height. The formation of a triple top pattern suggests that buyers have attempted to push the price higher 3 times, but have failed to sustain the upward momentum each time. This repeated failure suggests a strong resistance level and exhaustion of buying pressure, potentially signaling a reversal from an uptrend to a downtrend. Traders typically wait for the price to break below the neckline, which is a support level formed by connecting the lows between the peaks. The breakout below the neckline confirms the completion of the pattern and validates the reversal signal. Triple bottom. A triple bottom occurs when price reaches a significant low, rebounds, declines back to the same level, forming the second bottom, rebounds again, and then declines once more to approximately the same level, forming the third bottom, before reversing direction to the upside again. Visually, it resembles the letter M with 3 troughs of approximately equal depth. The formation of a triple bottom pattern indicates that sellers have attempted to push the price lower 3 times, but have failed to sustain the downward momentum each time. This repeated failure suggests a strong support level and exhaustion of selling pressure, potentially signaling a reversal from a downtrend to an uptrend. Traders typically wait for the price to break above the neckline, which is a resistance level formed by connecting the highs between the troughs. The breakout above the neckline confirms the completion of the pattern and validates the reversal signal. Triple top and triple bottom patterns are considered stronger reversal signals than their double counterparts due to the additional confirmation provided by the third peak or trough. The repeated failure to sustain the trend in the same direction adds weight to the reversal signal. As with double top and double bottom patterns, volume analysis is considered when interpreting triple top and triple bottom patterns. A decrease in volume during the pattern formation and an increase in volume during the breakout can further validate the reversal signal. Traders may estimate a price target for the potential reversal move by measuring the distance between the peak or trough and the neckline and projecting it downward or upward from the breakout point. This projected target provides an objective for potential price movement after the pattern's completion. And that's it. Thank you for joining us on this journey into the fascinating world of chart patterns. We hope you've gained some valuable information that may improve your trading. If you found this video helpful, be sure to give it a thumbs up and hit the subscribe button below for more insightful content on trading and investing. Also, don't forget to leave a comment sharing your thoughts or any questions you might have. We love hearing from you all. And for those eager to dive even deeper into the world of trading, check out the links in the description for recommended resources and further learning opportunities. Thanks again for watching. And until next time, may your charts be clear and your trades be profitable. Happy trading!